Yeah, no, I'll never go back. And it's unfortunate because this is what people talk about. It is the reality, and it is true to make this much of a bold statement that this is the loss of the American dream. The loss of my kids will be better off than I was. That young people can afford to buy a home and raise a family in a nice neighborhood. The reality is when you have the 1% control so much of the wealth, you're likely to piss off a lot of the other 99%. And that's what's happened here.
Welcome back to Collapse Life. I'm your host, Zahra Sethna. Before we begin, please take a second to like this video and subscribe to the channel. It really does help us keep these conversations going. Public confidence in the economy is at rock bottom right now, and the reason is not that hard to understand. No matter what the official indicators say, ordinary people know what they are paying for gas, groceries, tax, rent, and everything else it takes to keep a household running. The numbers may say one thing, but the checkout line says another. Here today to help us make sense of that gap and what may be coming next is Greg Weldon, a 40-year market veteran and founder of the Global Macro Strategy Report. Greg looks at the big picture monetary environment and he combines that with hardcore technical analysis across markets. And Greg, it is so great to have you with us right now.
My pleasure. Always happy to contribute.
Thank you so much. So we understand that you're just back from a poker competition in Las Vegas, and that feels like the perfect place to start this conversation because with poker, you have to know how to read the table, you have to know when people are bluffing and how to manage risk and what to look for and how to decide whether the hand you're being shown is the hand that really exists. So I think it's a great kind of metaphor. So my first question for you then would be, when you're looking at the economy as it stands right now, what is the table telling you?
Right. I'll tell you what, you did that very well. I mean, that was well said, and I really mean that because it's a multi-dimensional game, and it is thinking. And at some point, it's kind of like the old Ralph Cramden. I know that you know that I know that you know that I know you're bluffing, but I still can't call because I don't have enough chips, that kind of thing. But yeah, it's intense, and it's a lot of math, a lot of psychology, and that's why I love it. It's a 3D, chess game, and very much like the markets. And in fact, 10, 15 years ago when poker started to really become popular, I've been playing in Vegas in the World Series of Poker since 2006. And you see, and I've cashed about 40% of the tournaments I've actually played in. So it's a pretty good track record, knock on wood, But you are kind of gambling, but I'm not a gambler either. And that also applies to the markets. It's like, look, you can go play slots or craps or roulette or anything where the house has the odds, you're contributing. It's like, you think these hotels pay their own electric bills? No, the customers pay the electric bills, and you see all the lights when you go to Vegas. So it tells you a lot. Well, it's kind of the same in the markets where you have to kind of figure out, and what you said was very well stated in terms of it's different from what the government may be telling us, or certainly what financial pop media, what I call pop media, financial journalism on TV is telling us versus what the cash register is telling us.
Right.
And so when you break down the numbers, I think when you read, see, to me, when I look at this, I go into the micro level of the data. And the micro level is where it starts to kind of blossom. And it's one of these things, they always talk about green shoots in the economy. It's kind of green shoots in the micro data where it starts to blossom and pushes through the surface where people can see it. And then all of a sudden you'll have one story where this will be the fact for 2, 3, 4 months sometimes, where the data is eroding or improving and you don't really see it until there's a story out there where it's an epiphany to everyone. And I think we're kind of in that zone with the stock market relative to the economy. And this is for a variety of reasons, AI being one of them. And when you talk about the perfect environment, kind of like being a casino environment to whatever extent here, that if you don't get paid off immediately, if you're not getting, whatever X times your money, that you're getting cheated. And financial television will tell you that every, 4% decline is, the generational buying opportunity of a lifetime. And I think that's, doing something of a misdeed for the public out there. When the public knows and the public understands that when you look at something like real wages, where you take inflation rate against the rate of change in whether it's personal income, which came out today, and there's a lot to dissect there, holy mackerel,
Really?
but relative to consumer price index, real wages are deflating, all right? The savings rate hit its second lowest level that was in 2022 and 2023 since 2008. So
Wow.
consumers are spending their savings to make ends meet. And you say, wow, it's a big increase in spending. When you break down the spending, 2/3 of it was on things you need to buy, like insurance, gasoline, and food. And only 9.6% of the total growth in PCE, personal spending, was in discretionary items like furniture and stuff like that. And especially, and I always look at this in retail sales, it's the same. Eating and drinking establishments. That's the margin of the discretionary, how the consumer feels. He'll go out more to go to dinner or to go out and party when he's feeling good. And likewise, the opposite of that, we're on the flip side of that. And you can see in the retail sales, gasoline in March, 66% of the growth was in gasoline. And the change in April was 47% was gasoline. At the same time, you had the lowest 2-month year-over-year rate of change in eating and drinking establishments in dollar terms, since the pandemic. So the data is there to suggest the consumer is really struggling. And you can talk AI, you can talk chips, you can talk all you want. If you break down all the data on output and chips and particularly computer hardware and computer peripherals, which go into the use of chips, and this whole dynamic around AI, it only represents around 17, 18% of GDP. And it's only GDP growing because of the dollars being spent on capital spending, which will replace human labor. So this is, this whole idea that this is going to keep the stock market floating and provide us another 20% of upside when the consumer and the consumer stocks and the consumer ETFs are breaking down to new multi-year lows against the S&P 500. That's a major warning sign, and people aren't paying attention to it. They are so complacent around what the consumer real position is, and I think that's I'm doing a piece right now, and I'd be happy to send it to any of your listeners and viewers. It's called Gravity, and I think you're in a situation where gravity is about to hit the stock market because it's floating in space. It's the most detached from the underlying fundamentals, and it's also the most stretched momentum-wise. And I date my data back to 1902, and that's saying a lot for me. And I'm not a doom and gloomer, but this is really kind of way out of whack here.
If you think about 2008, what are the similarities and differences between then and now in terms of kind of just the moment we're in and what might happen in the short term right now?
Yeah, the differences are this is not, it's going to be a consumer, because of inflation as opposed to a consumer because of a deflation in the housing market. So that's the number one difference. The number two difference is I don't think you have the same systemic risk in banks and kind of the big institutions that you had back then. So that's a major difference. The big similarity is the thing to kind of focus on, because what happened in 2008 is kind of lost in the big picture because QE changed everything. When you're talking about debt increasing to the degree it was increasing, and all of a sudden you're talking about going through the level of annual GDP, and to a degree now, if you throw in household debt, which is 20 trillion, and you add it to the we the people's debt, it's not government debt, it's public debt. That's what they call it. It's 36 trillion. You're talking about almost 60 trillion in debt against GDP that's less than half that. So that's problematic, and I call that the debt black hole. And what that means is whenever you start to see signs of deflation in growth in consumer final demand, in domestic final demand in the US, they will have to reflate, even if inflation is higher than they want it to be. And this is going to be an interesting playoff with Warsh and the new Fed, which we could talk about for 2 hours. But this is a problem going forward because it will be the same. Because I wrote in my book actually in 2006 when we called the decline in 2008 and said they would monetize government debt, which was considered monetary heresy to say something like that back then. But now it's the path we've chosen. And when a central banker is staring into the abyss of a debt deflation, they will choose to reflate every time. And what does that mean? Another big round of dollar depreciation. And that's going to be a boon for assets at some point in time. But it's how you get there that's going to be the problem, because the Fed is on the other side of the fence right now.
Right. The big focus right now for sort of the ordinary person is oil and gas because of the conflict in Iran and the prices at the pumps. And energy is really embedded into everything else. So food, shipping, construction, the data centers for AI, all of that. Yeah. So let's talk a little bit about what your position or your thinking is on oil and gas prices. What are they telling us, and where do you think things might go?
If you listen to, financial television and you listen to the government, basically telling you it's going to come down hard and fast, gasoline is going to be back to $2 and so on and so forth. I couldn't disagree more with that statement. It's pretty simple. Supply and demand fundamentals. When you break down the U.S., we want to say we're energy independent. That's true if you include natural gas. It's not true if you include gasoline and crude oil. All right. You want to say we're exporting crude oil, which we are, but we're still mostly a net importer because we produce record amounts, 13.8, 13.9 million barrels a day. but what they call throughput into refineries to produce gasoline, heating oil, distillates, all these things, is 17 to 18 million barrels a day. So you're talking about a daily deficit of 3 million barrels that has to be made up either by inventory declines or imports, and that's how it's worked. Now, because of the war, you have seen inventories draw down by 45.7 million barrels in just the last 10 weeks. Right, that is a huge amount. And the level of crude oil inventories right now is below the 5-year low and at a level that is historically low. And when you throw in SPR, because the 50 million decline in inventories is in addition to a 30 million increase from SPR, that was a decline in SPR. So it looks like it's a drawdown, but it's actually added to the market. You're talking about almost an 80 million barrel decline in crude oil inventories in this country to a level we haven't seen since the 1990s. So this is a kind of a problem going forward. And when you talk about this kind of thing, I think it's important to note that gasoline in particular is even worse. You're talking about percentages below year ago levels, double digit percentages versus 2 year ago levels in terms of inventories. And this is despite huge increases in output because of all the throughput into refineries. So this is really interesting to me. And the levels of inventory in gasoline that you see after the peak driving season, which just started.
Right.
Point of all this is to expect gasoline back to $2. I think that's a folly to thought process. It really is. And then when you talk about the whole thing, to me, gasoline at 240, crude oil WTI at $65, if you get there, is value big time relative to the simple supply demand fundamentals. And then I would also add too that the other thing in all of this is the base effect, because really the impact that you're asking about is on inflation. Well, last year into the fall, gasoline fell not only below $1.90, but below $1.70. All right. So you need to see that kind of decline to wipe out a positive inflation base effect when you compare the year over year numbers. That's going to last right through to the election. And what have we done with Iran? We gave them 60 more days. And I've said since the beginning of this, since they had the first ceasefire at the end of March, that Iran, puppet strings being pulled by Xi and China, are going to try and drag this out as long as they can through the 250th birthday towards the midterm elections to try and weaken Trump. Maybe it doesn't work because of redistricting and some of the other things going on. The debacle that New York city politics is now, for example, sets a bad precedent for the Democrats. But nonetheless, this is still a thing where this isn't over, okay, in terms of what's happening with Iran. Nothing's really been settled yet. And I think this is a ploy to drag it out. So to me, the chances of seeing any significant decline in inflation from energy is just not the degree that people might want it to be. And number two, and we could talk about this separately, is the rise, the acceleration, and the broadening out of higher inflation in services, which still makes up the bulk of the economy.
Yeah, that is something that I wanted to ask you about because I've seen you writing a lot about that. So can you just explain that for the layman, goods inflation versus service inflation, and what your take is? Yeah.
Service, the bulk of the economy, of course, and consumer, the bulk of the economy. So those two things combined are the bulk of the economy. When you look at the CPI number, the most recent data, service price inflation X energy, and energy services is natural gas and electricity. And electricity 6%, 5.9% year over year. So it's high, and it's going to go higher because of data centers and competition and a whole nine yards. But when you break down the 84 service sector CPI indexes, all right, 67% of them are above 3%. All right, 49% are almost half, one tick shy of half, are above 4%. All right, and 36% of them, more than one third, are above 5% year over year. And most of the things, and many of them, there's 13 of them in double digits, are necessities. And again, you go back to looking at spending. All the spending growth is on necessities versus discretionary items. So this all pieces together as one kind of puzzle that suggests that inflation is not dead. And I did a piece last week, ding dong, the witch is dead, ... Not because the inflation witch is not dead. Because inflation in services is real. It's not going anywhere anytime soon. Consumers struggling with low savings below credit card debt. I mean, real income, or rather income below inflation. I mean, these are things you see as a precursor to a recession. So, if the Fed were to tighten, the dollar's already breaking out. Monetary conditions are tightening. Credit conditions and lending standards are tightening. I mean, this is a bad scenario for the consumer going forward. And again, gravity of that situation will eventually affect the stock market.
Mm-hmm. You've also been warning that the food price inflation may be the next big thing coming. What kind of indicators are leading you to that conclusion?
Yeah, and this is big on the weather. And we could talk all day about some of the science around what's happening on the planet, the polarization, the intensified volatility at both ends of the spectrum, because it is pure long-term science, astrophysics to the max. And I'm a geek at heart, right? So I love this kind of stuff. But yes, you have a bunch of things going on with food right now. First is razor thin margins up for error in supply side dynamics in many of these commodities, which have gone way up and have come way back down. I mean, that has been a source of disinflation. Stuff like cocoa and coffee went to records, it's come all the way back down. That's about to shift again. And it's, so there's razor thin margins for error. And not only that, when you talk about the US growing season and crops in the ag sector here, the USDA is very optimistic on yields. First of all, fertilizer costs a lot more at the peak of the application season. So you're talking about expecting optimum yields into that situation alone seems problematic to me. And then when you're saying you're going to have no weather problem because we can't afford any supply side problem or prices will surge, I think that you have to look at a couple of things. Number one, the snow cover this year in the western part of the U.S. was the lowest on record. All right, so the runoff of water down big. Fog in California down 30% against a year ago. That's a big source of water. And you're talking about a drought in Northern California right now, one of the worst they've ever had. And you're talking about El Nino, which is hitting, which is affecting already sugar, cocoa, some of these commodities that are grown, particularly in places like Indonesia, Vietnam. India has a very low monsoon season. China, massive floods have wiped out huge patches of rice paddies, and things like this are going on right now. Thailand and sugar, Indonesia and Vietnam with coffee. So when you talk about Northern California, they produce like something like 90% of our lettuce and 75% of our tomatoes, or vice versa. I forget which is which, but they produce a lot of our fruits and vegetables. Fruits and vegetables and CPI is already 6.9% year over year. All right, big monthly gains just this past month. And you're talking about a drought, and what NOAA says, the Weather Service says could be the worst El Nino in history. And they just upped their forecast, which in February, 25%, 1 in 4 chance, it'll be the worst El Nino in history, to 63%, and they've extended the time frame that it's going to last into December. So this is a problem in terms of what is the risk reward here. All right. Well, a lot of these commodities are priced for the most favorable outcome on supply. That's not what's going to happen here. So to me, this is a problem that's already in play. That
Yeah.
again, people, it's not above the ground yet. People are not really kind of seeing it. And I post a lot of these articles on Twitter. There was just one about Indonesia and some problems with some of their crops too, cocoa in particular, coffee as well. Countries like the Ivory Coast and Africa, it affects different parts of the world in different ways. The numbers are off the scale. It's stuff that I produce within our research. So I think that the agricultural commodities will be a big play in the second half of the year in terms of markets you could trade. And I also think it's going to contribute to an inflation that's already in services. And so if it comes down in gasoline, I see these other things kind of taking the lead on the upside. I don't see inflation anytime soon coming back below 3. And the Fed and this new chairman Warsh has promised to do whatever it takes to bring it down to 2. That's a scary thought process. I think it's a lot of words for effect to give him credibility coming in. I said to my clients, he's going to be inflation vigilant from the get-go because he needs to be that right now. Whether that actually comes to fruition or not depends on what the consumer looks like in 6 months.
On the food front, I wanted to ask you a little bit about timing, because we're talking about fertilizer costs, we're talking about El Nino hitting, and snow melt and all of those things. Those are all affecting farmers now, but
Yes.
we won't see the results of that harvest for months now. But we're already
Correct.
seeing increased prices at the grocery store. So at what point does that stretching of the dollar for the average consumer become so much that it snaps? And what will we be looking at towards Thanksgiving, Christmas,
Yeah.
and then rolling into next year?
I mean, I think you're on the verge of that now. I think the most recent PCE data that came out this morning really kind of exemplifies this. And it's it's kind of it's 2 different questions. When does it affect the consumer to the point where it's so visible that people can't deny it anymore? They can't go on TV and say the consumer is strong or the labor market is strong. We could trash the labor market all day long. The number of people dropping out is 4 times the number of people getting new jobs. Those people are no longer counted in the unemployment rate. That's just in the last 12 months. 2 million people dropped out, 500,000 new jobs created. That's 1.5 million people that are no longer counted in the unemployment rate. It'd be 6%, not 4.3. The participation rate in the labor market, the lowest since 1977 outside of the pandemic when nobody was working because everyone was closed. And these
Right.
are serious issues that really the market's not looking at. And when people go on and say the labor market is solid or the consumer is resilient, the consumer is only resilient because he's drawing down savings now to really
Exactly.
low levels that in the past have always preceded kind of recessions and mini crisis periods. So when does all this hit? I think in the next couple of months. I think it's really beginning to hit here. And I think that, like I said, kind of once the war is not the front page news every day, where Donald Trump is declaring victory, and then the next day he's going to nuke the civilization out of existence. How do you trade those markets? You don't. Now you're back to the macro fundamentals. And like I said, AI and all the chips and all the spending on capital spending by these companies is great. Google's breaking down right now. Amazon's breaking down right now. Amazon relative to the S&P has always been a leader, is breaking down. The online retailers breaking down. So this to me is like happening. Just people aren't really looking at it.
Mm.
And I've never been one that says the market's just going to melt down. I always thought it'd be a slow bleed. But the longer it stays up here on these kinds of things, on optimism around gasoline coming down to 2, which probably isn't going to happen, the more vicious it's going to be on the backside. And you always, I do anyway, because I've been doing this for so long. One of my first big money years was in '87. We called the crash in '87. It was pretty easy to see. Some of these things are easy to see when you're looking at the micro data and seeing it expand and expand, and all of a sudden you start going, hello, is anyone else watching? Because that's kind of where I feel we're at now. But at some point this will become a reality to everybody, and it's going to be, I think it's going to be problematic. I kind of see, you already see it in gold, you see it in crypto. I mean, you have home sales today are breaking down multi-year trends. I mean, the data is bad. The market hasn't really reacted to it yet. So I think right now is a time to take protection, because to me, it's almost like an all asset risk of deflation right here.
Mm.
And then at some point they'll free up the dollar. And a lot of it is the dollar breakout. Dollar breaking out is one of the worst possible things you could see for stocks. I've sent you the charts here. I mean, when you go back and look, even to before 2008, 2009, two things, the consumer and the dollar. They're always leading. Right now, the consumer's already rolled over for like almost 2 years now. But the dollar is now just breaking out on a long-term basis. The correlation with the higher dollar and lower stocks is very tight. It's one of the tightest intermarket correlations out there. So to me, you can see the periods where dollar depreciation led the stock market higher, where dollar appreciation led the stock market lower. It's very simple. You look at an overlay, the chart is very clear on this. The correlation is high, in terms of the numbers. So to me, the biggest thing to watch right now is the dollar, because that's reflecting the thought process that Warsh is going to continue to tighten monetary conditions. And at some point, that has an impact on asset prices. And Warsh made an interesting comment, too, about the one place we haven't seen any rollover is in stocks. So I'm almost of a mindset that maybe the Fed wouldn't mind trying to let some of the air out of the bubble of this market. The problem is once you do that, it's like, letting the genie out of the bottle. You can't necessarily get him back in there. So it's going to be tricky. But I think protection right now is more of the, it's sometimes if you want to go back to poker, we'll bring it all the way back around, because sometimes folding is the strongest move. And right now,
Well,
I think folding protects your assets.
hasn't Warsh also said that he wants to see the Fed kind of moving away from managing the market, so to speak, that like, he wants to kind of reduce down Fed communications and things like that? Talk a little bit about what's happening there.
Well, I've been saying for a long time the Fed's too transparent, because it just opens the door for problems, for criticism, for them to miss. The Powell Fed, I think Powell's been great. I mean, I wouldn't wish this job on anyone. I wouldn't. You couldn't pay me enough money to take this job, right? But he has missed the turns. Every single turn he has missed. All right, he's been late. And I think that when you come into the Fed as a Fed chair, you want to talk like Warsh is talking. But once you get in there, you kind of get, and this is not going to sound right, but I'm going to say it anyway, institutionalized. All right. Because all of a sudden now you're a Fed guy. So you're going to kind of go with the history of the Fed. And in that context, the one thing he keeps talking about is balance sheet reduction. You have 36 trillion in debt. You have to roll this stuff over all the time. Trying to reduce the balance sheet right now would tighten monetary conditions, which would break the back of the stock market. In my mind, no doubt about it, because you're opening the door for a bond market crisis, which is the last thing they want to see, because that's deflationary and that's the abyss they don't want to stare into. Certainly don't want to fall into. But it's a tough job. I've also made the analogy of, Nick Walenda walking across Niagara Falls on a tightrope. That's kind of the Fed's job right now. I mean, it
Yeah.
really is. So again, I wouldn't wish that job on anyone, but Powell kind of made it across. I've also used recently the analogy of the tallest wave that was ever surfed, which is off the coast of Portugal,
Mm.
and how basically the sea was very calm after Volcker when he defeated inflation. But then you got Greenspan and the waves started to come up, and then you got Bernanke and the waves started to curl, and then you got Powell. Now the wave and the white water is rolling down at him, and now Warsh is looking up, and the white water is right behind him. So I think that this is kind of what's coming down the pike, and I think ultimately, when you see what happens with the consumer, the Fed will be forced to acquiesce to higher inflation to protect growth, because without growth, you can't service the debt, can't reduce the balance sheet, can't do any of the things that he's proposing to do. And I think that he's going to get caught in the crossfire here and really have no choice. And that's going to be a boon to asset prices when the dollar comes down. That's the time to buy gold. I think it maybe another $400 or $500 lower, but I think you're going to have some really good buying opportunities out there. Just not now. Now's the time for protection to wait for those buying opportunities.
Right, got it. On the dollar, there was something I wanted to ask you about that sort of cuts against the popular geopolitical narrative. So, the Treasury Secretary, Scott Bessent, recently said that Iran may now be invoicing oil in dollars. Venezuela might also be coming back to dollar invoicing. Russia may want back into the dollar system after the Ukraine war. We've been hearing for years that the world is fleeing from the dollar, and they've been building alternatives, moving into gold and the yuan and local currency trades and things like that. But is Bessent kind of hinting at maybe the opposite happening? Is it possible that people are holding their nose, they don't really want to, but the dollar is becoming the toll booth that they complain about, but they still have to drive through?
Well, I would say when Iran ships most of their oil to China, China doesn't necessarily agree with what Scott Bessent is saying. And I would say that this is trying to prop up the dollar, for one thing, because it is, in fact, under attack. Right now is the most recent data. It's like a flip-flop now to where total global central banks hold more gold than they do U.S. treasuries. That's a big tell right there. And I still think that, when you're talking about China, exports and imports, 3-2, what we export and import every single month. Okay, they have something to say about this kind of stuff now. All right, you're starting to see more invoicing in renminbi. Sure, there's lots of problems with the depth of the market in China, with the bond market in China, all of these things. But the fact of the matter is, all right, that China is now the premier global trader, okay, over the U.S. And I think a lot of people said once Trump went there, I thought it was interesting how Xi gave him the royal treatment, because keep your friends close, but your enemies closer. Xi is a smart guy. His father was assassinated was killed in an assassination attempt on Mao. He was one of Mao's cabinet members. Xi was swept away by the Communist Party at age 6 and groomed to be exactly what he is now, a Maoist manifest destiny guy. Okay, Vietnam for their oil and gas, Philippines for the fishing, Malaysia for the shipping routes, and certainly Taiwan. Overtures by the Kuomintang Party in Taiwan now of reunification with China. And the leader just visited Xi in China, which hadn't happened for decades. So there's a lot going on in the background that people don't talk about in the U.S. So Bessent and Trump can say whatever they want. I don't think that represents the reality of the world out there. And when you say Russia may reprice their oil in dollars, I've said, I must have missed when Putin said that, because I really don't remember that. So, Mr. Bessent, maybe you can provide us the quote where he actually, said something like that, because no way. You're talking about Iran, China, Russia, the new kind of triad of power on the other side of the world. And this is a global world war right now for resources. It has been since 2018 when they opened the Shanghai crude oil exchange and priced it in renminbi and got used to buy OPEC as the benchmark, and then got Russia to benchmark their oil price against it. So this has been going on now for 8 years, and I think it's a one-way train. And eventually, you're going to start to hear more stuff about blockchain types of dynamics using renminbi and gold and other currencies, where you can say take a trade between Indonesia and say India, and take the currencies, each currency, take the volume of trade, take the particular thing you're trading, and come up with a formula where it's so precise in terms of the transactions, you're not going to need the dollar. So I think that that's one of the things that's kind of, when you see the debt, when you see the growth, when you see all these problems the Fed is facing here in the near term with the consumer, I think this is one of those things where it's kind of like dollar depreciation. I mean, when you go back to say, oh, I mean, just even post 2000 and back to 1985, the Plaza Accord. I was around then. I was trading then in the COMEX in the World Trade Center. And the morning that they announced the Plaza Accord to weaken the dollar's down like 97% in gold terms. Okay, the gold adjusted value of the dollar is what I look at to measure the dollar. All right, you could keep debasing that over and over, like Argentina did, that is doing the peso, like Venezuela did with the bolivar, like Turkey, all these countries that have all this debt. And it's kind of the path we're headed down a little bit, particularly when you see the politics that are taking place in places like Minnesota, Oregon, and now New York City. So, I worry about that from the future. The longer term health of the dollar, to me, not very good. But in the near term, because of the interest rate differentials, because of the hawkishness of the Fed, because of some of these other things, the dollar's rallying, and that's going to choke. I think that's going to choke off the last bit of asset price, bull market that we have here, and that's going to be a problem. And they're going to have to address it with a weaker dollar at some point in time.
I mean, you mentioned gold as potentially being an asset that can benefit in time to come. With everything that you've been talking about in terms of the volatility, are there other assets or other areas of the market that you're looking at as potential opportunities?
Yeah, I mean, certainly a broad section of agricultural commodities, and I know that's tough for people to play. We had a little, discussion around ETFs before. It's, off air. I mean, it's too bad that the ETF trackers don't track better. So you could be, bullish some of the commodities or bearish some of the financials and stuff like that. The futures market's the way to play it. And I think in the future, when the dollar is played and when stocks do bottom, and even when gold bottoms, gold will outperform stocks, and stocks will not keep pace with the debasement of the purchasing power of the dollar. And so in that case, you kind of need to be exposed to some of these other things. Energy would be one of them. I like uranium. I like the nuclear sector. Some of the real kind of soft tropical commodities I like. So from that perspective, I think there's a lot of ways to play that. I also think there's currency plays to be had there with commodity exporting currencies, particularly those with links to China. When the dollar peaks, those are going to be the currencies you're going to want to own. So I think there's a lot of ways to play what's coming next that is not necessarily just being passively long stocks, at which points you will fall behind in the terms of the debasement of value of your wealth and income and money. So I think, it's funny because, I run a CTA too. I'm a commodity trading advisor. And I think it's the best way to trade these markets as futures. They're liquid. You're in and out quickly if you want to be. I prefer to take long-term. I'm not a scalper or trader. I want to have long-term positions. Something like copper is another thing that would be interesting to me too in that same context. So you kind of wait for those opportunities to buy these things. So a good CTA now going forward. And it's funny because we just raised some new money from a new client and we had this conversation on the phone. And I said, it's kind of like, look, right now, this is crystallizing for the things that I do to really provide more value add to regular investors. And he said, you've been waiting 40 minutes, this whole phone call to say that to me. I say, I've been waiting 42 years to say this because I've kind of, it's like, this is the time. And I've seen the entire movie that's led us to here where that's going to be something that people are going to have to take advantage of to stay ahead of the curve. And, I'm not promoting my own business. There's a lot of great CTAs out there, that have a good history of trading all kinds of markets. You can say markets have changed and they always changing. You always have to stay ahead of the curve as a money manager too. But to me, the one thing that doesn't change is human behavior. And
Right.
that leads me to believe a lot of the things that what I'm saying is actually going to be the way it plays out.
Yeah. I think it's probably worth just mentioning that nothing in this conversation should be construed as investment advice, and people should always check with their financial
No.
advisors.
Yes.
But, I think these are questions that are knocking around in a lot of people's
Because the risk is
minds.
huge. You need to manage the risk. And this is why a lot of people don't like futures, have failed in futures. They don't understand the math. They don't understand this, the underlying value of the contract, not the amount of money you have to put up, these kinds of things. You need to be well capitalized to trade some of these markets these days because the volatility. Take gold. I mean, it can move $100 in a day.
Yeah.
That's a big chunk of change. You're managing $1 million and you have a couple gold contracts on. That's high risk. So I'm a very low risk guy. So it's frankly, my job's become a lot harder, but also a lot more necessary for people to, be involved in these kinds of things. I really, truly believe that.
Yeah, absolutely. Can you talk a little bit about long duration bonds? Is that an area for investors to be wary of or interested in?
Yeah, that's a tough question. The bond market is the toughest kind of market for me right now because you would think that there's a tendency for yields to go higher. But I also wrote in my book in 2006. I'm not here plugging my book from 20 years ago, but was that, look, there's something I called monetary Armageddon. All right, and that is where you have a bond market crisis. It even goes beyond Japanese yield curve control, type of dynamics, where you have the Fed chair and the Treasury chief in the bunker, in the monetary bunker, when all hell's breaking loose, and they have to both turn the keys simultaneously to produce enough money to buy every bond ever printed. All right. So that's kind of the path we're on. So when Boris talks about, shrinking, I call it shrinkage. If you remember the old Seinfeld episode, it's like he wants to shrink the balance sheet. I don't think that's necessarily an attractive option per se. So to me, this whole thing around the long bond is, I, I, I think there's value there, yes, but that value is linked to the Fed being the buyer of last resort ultimately. So you have to play these off one another. I don't think it's the easiest trade out there. I don't think it's necessarily the safest investment. Not when you hear Warsh talking the way he's talking right now. He wants to reduce the balance sheet, tighten monetary conditions, and defeat inflation. He's going to have to take rates significantly higher. I mean, understand right now, the real Fed funds rate is negative. That's a stimulative thing. So if you really want to get policy back to neutral, you just got to raise rates 50, if not maybe even 75 basis points. To get to a point of being restrictive, they're going to have to go further. So if Warsh is serious, and I think a lot of this is for show and for kind of credibility and inflation vigilance and what a central banker is supposed to say. But at the end of the day, if he does what he's saying he's going to do, that could break the back of the bond market, create a bond market problem where the Fed, Treasury have to come in and buy bonds as the buyer of last resort. So I think this is problematic going forward. I think the bond market is kind of centered to it. But I think ultimately, again, it's the same dynamic. It's human behavior. Facing a deflation, a debt deflation, even worse, a debt deflation abyss, they will choose to buy bonds to reflate and devalue the dollar every single time.
You mentioned protection as being what people should be thinking about right now. So what does that look like for not maybe the institutional investor, but the retail side?
Yeah, and that's a tough question. Because I don't ever want to recommend someone just sell all their stocks, because stocks will eventually keep going. And if you're a long-term investor, maybe you have to suffer through a 40% decline to get to the next high that comes 5 years from now, 10 years from now, whatever it might be. I would say also that history teaches us that stock market can go sideways for up to a decade. So we have to be prepared for a stagflation event where stocks go nowhere and the cost of living keeps rising as they try and fight this without really kind of capitulating to this whole situation and supporting the consumer. I think they'll be forced to capitulate. But from that perspective, gosh, I don't know. It's a hard question. To me, it's more about how do you diversify out of stocks with some of your portfolio to at least have some protection. One of the things I try and do for my clients, if I see a bear scenario on stocks, I want to be pretty aggressive on the short side, because I know my clients, and we never would take 100% of anyone's money, not even close to that much of their money, but that they own a lot of stocks. So I feel that that's another way to protect yourself. But maybe, gosh, buying puts right now, I mean, the volatility's kind of come down a little bit. It's kind of scrunched out. The market really hasn't gone anywhere significantly since, gosh, the end of October. Really, when you look at it, the momentum has kind of waned, and you've made new highs in some things, not in everything. So that's a tough question for me. I think that's something you have to discuss with your own financial advisor to see what might be best suited for you based on your long-term goals, because I can't possibly know that for every person out there. But what I could do is recommend that people do take protection to some degree by diversifying, truly diversifying, not having different stocks, but by having different actual investments, in some of that being commodities and currencies.
One of the things that we've often talked to Peter Grandich about, and we'll just give him a really quick shout out here. He was the one who introduced us to you, Greg. And so, yeah, God bless
Wall
Peter.
Street whiz kid.
Absolutely.
Legend. He's a legend.
He is a legend. He's amazing. And we're always grateful for him. So one of the things that he and I have spoken about on Collapse Life before is the housing market, and how, buying a house used to be the biggest investment that most average families would ever make. And how that is is changing now. It's becoming even harder. It's, typical for people as they get older to want to downsize, but now because of interest rates and because of the way the market is, they're not even able to make that move, which is making it harder for first-time buyers. What are your thoughts around how that's changing? Will it ever go back or right size itself?
Yeah, no, it'll never go back. And it's unfortunate because this is what people talk about. It is the reality, and it is true to make this much of a bold statement that this is the loss of the American dream, the loss of my kids will be better off than I was. That young people can afford to buy a home and raise a family in a nice neighborhood. The reality is when you have the 1% control so much of the wealth, you're likely to piss off a lot of the other 99%. And that's what's happened here. You read some of the psychological studies. I'm big on reading medical journals, science journals, these kinds of things. And I don't understand the kind of the stance and the platforms of some of these people that are in politics now. You see some of the younger people with these really what to me are anti-American beliefs. But at some level, you also have to understand where they're coming from because it is the 1%. It is the polarization of wealth that's been going on ever since we went off the gold standard. This is all about dollar debasement and how it degrades. The one thing people say is going to be more inflation or more deflation. I say it's going to be both. But the one thing you can kind of count on is a lower standard of living when you continually debase the purchasing power of the currency. And that's what's happening. And the recent data came out this morning, literally hours ago. New home sales on the verge of breaking down. And one of the reasons is prices soared here in the last couple of months, makes it less affordable, obviously, with high interest rates. And if the Fed's going to raise rates already, you can kind of see the mortgage indexes are down, the mortgage market is down, mortgage bonds are down. And when you're talking about new home sales and existing home sales, they're breaking long-term secular uptrends here. And I don't hear a lot of people talk about this. When you look at the home builders underperforming the stock market, whereas they have been outperforming earlier in this, since 2020. So I think the housing market is a big problem. And I think that Warsh really kind of glossed over it. And I think that this is one of the main centers of angst among the basic population. And I think that this is a problem going forward. And I don't see it changing anytime soon. And I think this opens the door for more of this socialism type of socialist thought process to, enter our country, let alone that we've, basically, somebody said they're talking about whether you should allow kids of people that are in this country to be naturalized citizens. I believe in immigration. I mean, I really, the labor market wouldn't be the same without it. You need it, okay? But it needs to be done the right way too, and we haven't done it the right way. And what we've done is, and when you see what the people talk about, I'm not an expert on this, but what the Constitution says is, unless this is kids of a foreign invading army, I kind of say you got that right now. So to whatever extent, this is part of why you're seeing this rise in socialism in these particular areas of the country. And to me, that when you tie that in with the science around the planet and human beings and how people are disconnected, that also applies to the stock market, applies to the weather, it applies to everything. And that to me is it's hundreds of year cycle coming that's only going to intensify. So you want to talk doom and gloom, we can talk that. You want to talk the positive things like spirituality, the kinds of things around the opening up of human beings' senses and powers and how we're going to become even more amazing beings. That will be part of this. But it also means that because you're polarizing, you also have another whole half of the population that is becoming more volatile the other way. And we're seeing that everywhere. So when you apply that to the markets, when you apply that to housing, it all fits together as to what we see happening in this country right now and basically around the world. And even
Yeah.
in the animal kingdom, you even have animals acting out in ways. We have more shark attacks and alligator attacks here in Florida than we've ever seen. And there's
Really?
reasons for that with the food chain, which of course is linked back to El Nino and the coral reefs. And man, you could tie all of this together. It's like a huge puzzle. It's a 1,000-piece puzzle, and you don't have a picture of the puzzle. So you're trying to put the puzzle together, and it's tough. But once you start to put the puzzle together, you start to see the picture.
Mm. And it's a really complex picture. And for a lot of people, it is too much to take in all at once.
Yes.
And instead of trying to bite off pieces and see if they can understand it, a lot of people just sort of turn the other way and say, I can't deal with it. I'm just going to go on with my life. And um, there's almost a little sort of almost self-fulfilling prophecy in the sense that people are living off of credit cards and savings and buy now, pay later programs. And so when you go out to a mall or a shopping center, you see full parking lots. You see people
Yeah.
pushing carts full of goods. And so when other people see that, they think, well, everything must be okay. So I'm just going to
Yeah.
keep going. Right. So at what point does all of that
Tipping
start to
points.
sink in for
Got a
people?
lot of tipping points going on here, and I think that's one of them. And I think the simple fact that the data we just got, again, real income deflating now against CPI, PCE, whatever measure you want to look at, income is now deflating on a real basis. When you have now savings at a very low level nominally and well below the level of credit card debt, when you see the growth in credit card debt flatten out, I think you're at the tipping point already. And
Yeah.
so the degree to which you kind of come back to this and say, you have tipping points in the stock market, you have tipping points in politics, you have tipping point. Again, it's kind of all kind of interrelated into all of this in terms of this kind of big puzzle you have to put together. And I had a really good thought right when you asked me that question, and then we led into this, and I forgot what it was. So I'm like 110 years old, so I don't remember things so well. But anyway, there's another really good point to be made here around that this is it's just not going to change soon, and again around the kind of psychology of people out there, the anger, the frustration. And you said, oh yes, I remember what it was, and it's actually kind of funny actually, because I've always kind of wanted to be a stand-up comedian. It's one of my little dreams of going out and doing something just for the hell of it. And it's like you're way too young to remember the movie Network. Okay,
Oh, I remember.
when he got to the point,
Mad
yeah,
as
in the early
hell.
70s. Yeah, it's like I can't take it anymore, and I want to do a comedy tour. I can't take it anymore, and talk about all the things that we can't stand anymore because it resonates with everybody. Everybody feels this, and yeah, people can't take it anymore, and this is why you see the rise in social unrest. Half of these people are protesting just because they want to protest something because
Yeah.
they're angry. It's not
Yeah.
necessarily even that they believe in the thing they're protesting for, unless they're getting paid to do it. So I think this all ties together with where I want to go on a comedy tour. And I have some really good patter for this too. I think I've worked out. My son thinks it's hysterical, and I feel for him more than I feel for myself. The one time in my life where I say, I'm glad I'm not 20, because I'm not. The next 50 years are going to be tough, man. And
Yeah.
it's one of these things, I can't take it anymore. Get up, go to the window, open a window, stick your head out and scream, I can't take it anymore. And that's kind of where you're at.
I want you to get up right now and go to the window, open it, and stick your head out and yell, I'm as mad as hell, and I'm not going to take this anymore!
No, I think you're absolutely right that I think most people sort of inside, even if they're not consciously acknowledging it, inside there's something that's telling them that that is where we are. And
Yeah.
so for the average household who maybe doesn't have much, if any, of a stock portfolio, what should people do with this information? Should they be reducing debt, as Peter always says? Should they be
Yes.
trying to save some
If you
cash?
can.
Is it hard assets, income diversification? Should they go out and get a couple more little part-time jobs, food storage?
All of that.
What should people be
All of
doing?
it.
Yeah.
All of it. I mean, I think yes, I think in terms of assets, yes, I think precious metals. I mean, so maybe you buy on the way down, and I think you're at levels that are very close to what I call back the truck up moments. And I've said this before about silver, and like it's $61. Now it's kind of maybe you can get to 55. Gold I always thought would go to 3,500. You see these levels, and then you get any inkling of a shift from the Fed that might impact the dollar, you need to plow in there, because these precious metals will be much higher in the next 3 to 5 years. And I think that is the best way for the small investor, for the small guy out there. It's almost like, to some degree, you don't even bother as much about worrying about paying off debt. Debt, guess what? They're willing to write it off. The banks will write it off every time. It's like, who cares? And you already see an increase in the number of commercials about companies coming in here telling you how they can reduce your debt and get you out of paying it. So I think that's another little tell too. So I think not so much that, even though that would be a good thing to do and something. I have zero debt. I don't believe in credit cards. I literally have no debt. If I can't buy it, including my place here, I don't buy it if I can't afford to buy it with cash. But that's a good way to go about doing things. I think it's tough for most people right now because they don't make enough money to pay the bills. So that's a problem. But then I think also, yes, when you have extra cash, you're buying precious metals. Right now, the dollar's going up, so holding the dollar in cash not so bad right now, but you risk missing the turn, which could happen quickly. So I think that the precious metals are still the best way. Gold has always been the best way. When you compare the dollar to gold, it is appreciated really over the decades of time since we went off the gold standard, it's been the way to play it.
Any final thoughts as we come to a close? What should people be watching maybe over the next 90 days or so?
I think people should get outside, get on a jet ski, go to the golf course, go to the beach, do some spiritual work. I mean, I think that's really, to me, it's like, again, I can't take it anymore. I want to like get away from social media, get away from all this. But in terms of, I think assets and their investments and such, I think it's protection. I think it's okay to take some money off the table here. I don't recommend selling everything, because it'll spike and it'll come back. So it's going to be tough to catch those turns.
Mm-hmm.
But I think diversification, if you can maybe take some money out and stick it in silver and gold as it comes down here, I think that will benefit you over the long haul. When you look at the long-term kind of ratio spreads of stocks against the S&P, the S&P against gold and these kinds of things, and then you tie the dollar in, I think that that's a very good long-term plan, is to diversify and have some stocks, maybe hold some of your money in foreign currencies, which is easy to do pretty much at any bank. And then having precious metals would be the thing to do over the next 90 days. And I think by the time you get 90 days out from here, that might be the time you start to see some of these things pop off. Stock market starts coming down. Gold comes down at first, but then hits the bottom because they're going to play the dollar. They're not going to tighten. It's going to be an easing type of thing. We'll see that. So I'd watch the consumer. I'd watch the consumer shares, the consumer ETFs. The PNQI is the ETF that follows the online retailers. The XRT is the S&P retailer. And then the XLY is the discretionary, S&P discretionary retail ETF. Watch those things, and they're not keeping pace. And then you're watching the semiconductors. You're watching Google. You're watching some of the big powered, what they call hyperscalers, are starting to break down. The semiconductors against the S&P has exploded, starting to come down. So those kinds of things, when that kind of flatters out, then maybe it's time to re-enter the stock market too down the road. But I think that that's a second step from now. In the next 90 days, it's more about protection and maybe diversification and taking some money off the table.
That's great. I think that's all very practical and useful things that people can do. Just a reminder, again, it's not investment advice, just some sound perspective from someone who knows, who's been in the markets for decades. For people who decide not to check out for social media, where can they find you? Where can they follow you and subscribe to everything you have to offer, Greg?
In that case, I'll say don't go on X and follow me at Weldon Live. Okay, that's number one. But yeah, I'd be happy to send you some of the samples I sent the crew here of my work that really kind of shows you that this is really not opinion. This is data talking. I mean, I'm a data guy. I'm a math and science geek, so this is not like some self-vested opinion. You can email me at Greg Weldon, GregWeldon. I think it's the name on the screen, at weldononline.com. I also offer a boot camp on trading gold and silver, precious metals, the whole history of debt, how this plays out, the whole macro thing, trade, currencies, inflation, and then how to invest in these. Whether you want to buy physical metal, you want to buy the indexes, you want to buy the shares, you want to buy, maybe play the futures market. So it's kind of a how-to. It's a 12-part boot camp. And I did this in 2016. It also piggybacks off my book, which was 2006 Gold Trading Boot Camp. So we kind of resurrected it in 2016. We're selling it for $2,995 now because it's not so much about the money, enough money. So it's more about helping people. So it's $29.95 now on our website. It's 12 parts. It's really long. It's really in depth. It's really a lot of stuff. And I get a lot of people that email me and say, thanks for putting that out there. It's really helpful. So you might want to check that out as well. I also do the podcast, which is on X at money_podcast. It is called the Money, Markets, and New Age Investing. We're into middle of season 4 right now, and talk about all this stuff probably once, if not twice a month when, I'm not busy, managing our clients' portfolios.
Amazing. Well, Greg, thank you so much for all of this invaluable information. I do hope you can join us again soon because there is obviously a lot more to discuss.
It's going to be exciting times. There's going to be a lot of opportunities. Don't get me wrong. I mean, there's going to be huge opportunities coming, but it'll be in things that you might not necessarily look at unless you're really starting to broaden your horizons.
Well, again, thank you so much. It's been amazing chatting with you.
My pleasure.
And thanks to everyone who's watching. If this conversation was useful, please like the video and share it with someone who you think could use this information. To go deeper into what's breaking in society and what we can still do about it, head over to collapselife.com and subscribe. Free subscribers get all our latest news, but paid subscribers go the extra mile with the exclusive community discussions and tools to put plans into motion. If a monthly commitment is too much for you right now, we understand, and you can support us with a one-time gift using the donate button at the top of our homepage. Thank you again so much for being here. We will see you again next week. And in the meantime, just keep your chin up. It's only collapse. See you soon.